Welcome back to Rockstock Channel. It is Friday, April 25th. Following my brief Easter break vacation to Budapest last week and ahead of Rodney trekking in Malta, we figured we'd share our thoughts 3 weeks since Trump's Liberation Day and as Q1 earnings season has begun in earnest. As I've commented in recent Lithium Bulls and Rockstock Channel videos, I continue to see the impact of Trump's day-to-day tariff uncertainty as similar to the start of COVID 5 years ago. In particular, it is creating a supply chain shock, resulting in mass uncertainty to business and consumer decision-making. As in COVID times, I'm spending enormous amounts of time listening to a large diversity of podcasts focused on foreign policy, macroeconomics, and U.S. policy toward energy transition and critical minerals, and trying to read the tea leaves and synthesize the signal from the noise. Unusual in today's volatility is that it is not just equity markets hit, but U.S. Treasuries and the U.S. dollar. China's Xi Jinping seems to be taking a page from Tom Petty. I won't back down. Another analogy seems to be the Cuban Missile Crisis, in which, ironically, the esoteric rare earths and other critical minerals that we dabble in is proving to be America's Achilles heel. Trump and Treasury Secretary Bessent appear to be moving toward a blink, seeking an off-ramp. As in my recent discussion with Ashley Zumwalt Forbes, Trump has built on Biden's whole-of-government moves in support of critical minerals and energy policy, though there are some stark differences. Yesterday saw an executive order on seafloor mining, for which our recent work with the metals company has proved prescient. Interior Secretary Burgum's comments on CNBC yesterday that he's considering equity investments, stockpiling, and insurance guarantees for a mine baby mine, not just drill baby drill policy, further supports the broader mining equity thematic, especially U.S.-listed companies with U.S. projects. Well, April 8th, 2025 in the S&P and Dow proved to be the capitulation bottom, as was March 22nd, 2020. In my recent interview on Real Vision, I referenced some research I had read from my friends Gehring and Rosenzweig, who referenced Steve Miran, former senior strategist at Hudson Bay Capital and now chairman of Trump's Council of Economic Advisors, who penned a 41-page note entitled A User's Guide to Restructuring the Global Trading System. And then my friend and prior Rockstock Channel guest, Trent Barnett of Urias Hartley's, referenced this same paper in his April 10th note. Tariffs, there is a plan. We have included a link to this paper in the show notes below, which we will summarize in the next few minutes through our AI avatar colleague, Jane Battery Pack. Rodney and I will then further share our thoughts on this and many other topics impacting critical mineral supply chains, so stay tuned.
Good evening. I'm here to break down a crucial discussion that could reshape global trade as we know it. At the center of this debate lies America's strategy toward trade imbalances and currency valuation, specifically involving China and other global partners. Former senior strategist Stephen Miran's analysis highlights the persistent overvaluation of the U.S. dollar as a significant problem, driving up imports, weakening exports, and hurting domestic manufacturing. One key issue discussed is the approach to tariffs. The Trump administration previously implemented significant tariffs on China in 2018-2019, which surprisingly had minimal inflationary impacts due to a nearly offsetting depreciation of the Chinese currency. This example underscores the importance of phased tariffs. Implementing tariffs gradually rather than abruptly could mitigate market volatility and economic disruption. Moreover, there's a proposal for tiered tariffs, varying tariff rates based on each country's currency policies, trade practices, and security alignment with the U.S. This strategy aims to incentivize allies and trading partners to align more closely with American interests, effectively tying trade policy directly to national security. It's a strategic move to improve burden sharing among U.S. allies. Another significant consideration is the investment approach. Trading partners might receive tariff relief in exchange for substantial industrial investment in the U.S. Miran draws parallels to policies from the Reagan administration. emphasizing this strategy's potential to stimulate job creation domestically. This policy is particularly relevant concerning Chinese auto and battery investment, where controlled investment could significantly benefit the U.S. economy while maintaining security and economic sovereignty. Currency policy also presents complexities. Miran explores the feasibility of a multilateral currency adjustment similar to historical precedents like the Plaza Accord or the Louvre Accord. However, today's dynamics differ significantly, notably due to China's crucial role, which was not a central player in previous accords. Miran speculates about a Mar-a-Lago Accord, which would utilize tariff pressures to encourage major trading partners, especially security allies, to cooperate on currency adjustments. This multilateral approach, if achieved, could stabilize markets and minimize global economic disruption. However, if multilateral cooperation proves difficult, the U.S. might consider unilateral currency adjustments. One controversial proposal includes imposing a fee on foreign official holdings of U.S. Treasury securities, specifically targeting reserve accumulation practices contributing to dollar overvaluation. This action would be delicate and require careful coordination, notably with the Federal Reserve, to avoid unsettling financial markets. The overarching theme of Miran's analysis is clear. Careful sequencing and implementation of tariffs and currency policies are essential to mitigate potential financial market volatility and adverse economic impacts. The policy path forward seems narrow, requiring a balance between assertive negotiation tactics and prudent economic management. Ultimately, the future of global trade could see significant realignments, characterized by heightened distinctions between allies and rivals, increased market volatility, and intensified global efforts to find alternatives to dollar dependency. These developments underscore the intricate linkage between trade policy, economic strategy, and national security, setting the stage for a complex geopolitical chess game.
Two more comments before Rodney shares his views, the first quoting from Gehring and Rosenzweig's research. Commodities are now as undervalued relative to stocks as they have ever been. And now, fresh research suggests that the tide is about to turn, that the long-dormant natural resource bull market may be stirring once again. If recent hints from the Trump administration about Mar-a-Lago Accords amount to more than mere rhetoric, we could be standing at the threshold of a major shift in the monetary regime. And history reminds us that every commodity bear cycle has met its end with precisely such a shock. If we are correct, the major shift in the global monetary system may be imminent. The policies now being proposed could trigger another surge in commodities and natural resource equities. Rather than de-dollarization being driven externally, we now believe the catalyst may emerge from within the United States itself. Instead of retreating from the dollar's role as the global reserve currency, policymakers appear poised to double down on it. Both Treasury Secretary Bessent and Council of Economic Advisors Chairman Miran have offered hints as to their likely structure, which include revaluing the Federal Reserve's gold holdings, restructuring portions of the national debt, and implementing a tariff regime designed to define what Miran describes as a global commonwealth of allied nations. And secondly, specifically to lithium and other battery materials, I continue to put my hopium on a grand bargain later this year, the broad outlines of which include China agreeing to stimulate domestic consumption, and the U.S. agreeing to welcome China foreign direct investment into the U.S. in key industries like the EV battery supply chain, in which they are world-leading. A recent interview between two best-selling authors and New York Times columnists Ezra Klein and Tom Friedman reinforces this view.
They are at the forefront of a series of technologies that are competing with us within months on AI, right? The AI timelines for the two countries are months apart, if that. And then, as you've mentioned, they're probably ahead of us at this point on batteries, on electric vehicles.
Oh, not even close, yeah.
And on the ability to spin up highly complex supply chains. You're making an argument that even among Democrats, I think, is somewhat more subversive right now, which is that if you were a serious person, you would do with China what we did with Japan in the 90s, which is, by the way, when Donald Trump came up with all of his trade theories. This guy's had the same opinions on everything for decades and decades now. What we did with Japan is we brought in their car companies here and we learned from them. What China did with us was they brought in our manufacturers and they learned from them. And what you are saying is that if you take seriously how good China has gotten at manufacturing, then what you would try to do is begin bringing in its factories here as the condition of access to our market to learn from them.
Exactly. You should do 50-50 joint ventures with Xiaomi. You can build your cars here, 50-50 joint venture, number one. And number two, you have to build your supply chain here as well. So you're not just bring all the parts in, from China. You got to build the supply chain and the factory here, joint owned, exactly what you did to us.
So, Rodney, having listened to all that and read Steve Miran's piece, we've been talking a lot over the recent weeks and months with our clients. What's your view, I guess, just on the overall strategy of tariffs and this the potential devaluing, intentional devaluing of the U.S. Currency?
Yeah, look, Howard, I think that has been the intention for some time, and there were some other pointers in that document that you spoke of with Miran about a sort of managed decline of the dollar and some kind of a tariff or charge for foreigners holding U.S. assets, I guess, and inflating the U.S. dollar. So the question will be, the U.S. needs to see a managed shift. And as you spoke, they, broadly, they want China to have higher domestic consumption, not an export-driven economy, and, for them to be pushing all sorts of material out into the world, because as it needs to grow and domestic consumption doesn't climb, then it just forces more and more into the export market. And they had $1 trillion in surplus last year, and the US had 1.2 trillion in deficit. Obviously not with each other, but in aggregate. So I guess the debate is Trump's methodology in achieving that has been a bit of it wasn't on the bingo card, as they say. He's done some things that weren't expected, but I do think that ultimately, in order for the US to be more competitive, it will have to have a managed depreciation of the dollar. And that typically is good for commodities. If you look at historic charts, it always bodes well. A strong dollar logically would not be good for dollar prices of commodities. So one would expect a weaker dollar to be combined with higher commodity prices. I guess, for me, one of the things I suppose that people need to take cognizance of is, and I saw a good tweet the other day that said people in Europe think China's living in 2050, but China isn't. China's living in 2025. It's just Europe that's stuck in 2000. And I guess the point being, a lot of people thought of China as good at making toys and low quality manufacturing items, but what they've done in the last 25 years, roughly, since they've joined the World Trade Organization, and their education system and levels of skills, which is what Tim Cook from Apple alluded to when he spoke about it, not just cheap labor, but actually vocational training and skill, is that China has moved right up the curve in terms of the quality of goods that they can produce. And that is a direct threat to the US. Because it's one thing to have cheap goods coming in, it's another to having high IP items, EVs, battery cells, solar panels, humanoid robotics, self-driving, all of these things that moved right up the curve. And that represents a different threat. So I agree with the sentiment of weaker dollar, stronger commodities, but there's a bigger issue at play, and you get sound bites out of the administration about theft of IP and manipulation of currency and so on. So there are going to need to be some changes. And And now it's a question of if everyone's going to look to reshore, onshore, whatever you want to call it, deglobalize, is that going to mean individual separate supply chains and a rush to all commodities that each supply chain needs in order to compete in a global marketplace?
Okay, it's interesting the point you were making on China versus the EU in the last kind of 25 years. But this Ezra Klein, Tom Friedman podcast highlighted really like the last 5 years since COVID, and Tom Friedman was basically saying that like not a lot of people from the West have actually been to visit China. And he's been there like 2 or 3 times, and there's been a massive change just in the last 5 years. And there was always this, China copies everything, but they're not able to innovate. But in the last 5 years, they've massively innovated and taken over in a number of industries, and it's a real,
I think
competition.
they're the
So,
number one now, Howard, in patents, in lodged patents now. They're even higher than the US. So it's been a very steep curve. So that's 100% right. We always mention this, and you can see it in CATL's announcement, which impacts what we look at a lot in the battery supply chain and lithium, in that I think, if I'm not mistaken, they employ 11,000 masters and PhD graduates just in CATL alone.
yeah. And we do want to talk about that in a minute, but so the Miran paper talked about phased tariffs or the benefit of the tariffs in 2018, right? Like there was no major impact because it was offset by the decrease in the currency, but those were, I guess, they were smaller. They were steel, aluminum, and a few other sectors, but not as broad-based as this. But the world has changed, right? Like China, I think, capitulated or gave in, in 2018. But again, the last kind of 7 years later, China's posture is much more aggressive and confident.
Which is an interesting one, which is why I think Trump didn't go for the phased approach, which is why he's gone for, like, what you would say all in, I guess, if you're playing poker, is that he's trying to do negotiations with all of the other counterparties to basically snooker China in, rather than just do, you know, a single a trade dispute. He's looking to shut down transshipping, where China just sends it through other avenues or produces elsewhere and does it. So they're trying to do a more comprehensive, this is almost trying to do a whole change in the global order in one shot. The part that I struggle with, Howard, is, I mean, I understand that, but I struggle with trying to pick tariff battles in sectors where you are nowhere close to being competitive. That's the part I don't really understand. So you've seen all those joke memes of the Americans making sneakers and whatever else. I don't understand that part. The reshoring of pharmaceuticals, I think, is possible, and you've already seen one of the majors about to make a big investment into the US. You've seen that in semiconductors with Taiwan Semiconductor, but I don't understand it. So the question is, and you touched on this earlier, is would you be better off to do like China did with their auto sector, to say, if you want to do EVs, you've got to do JVs and share the IP, is for America to say, fine, you can do cars and what have you, and bring the battery supply chain technology to the US and share the IP?
We've been arguing that for months, and Tom Friedman argues the same in that clip that we just shared. So again, I'm hopeful. I'm trying to like synthesize and simplify because there's so much complexity, and that Steve Miran, going back to my economics 30 years ago, major in trade flows, there was just a lot of, my head was spinning and trying to figure out all the factors, the moving parts of that policy. But again, if there's a grand bargain, like China's overproducing, and the last 5 years has shown that. You talk about the 1 trillion, deficit. They're making way more cars than their economy can absorb. I don't know why domestic consumption is, why it's so difficult to stimulate domestic consumption
I
in
mean, I
China?
guess
Do you have a
that's
view?
easy. How it is, most of their wealth is in property, and what little else outside of that is in the stock market. And property is now tanked because they overgeared and over leveraged, so the wealth effect is down, and the stock market's done nothing in 15 years. So, and most of the quite a high percentage of companies are unprofitable. So it's very difficult to. And then the other thing is there's a limitation on your foreign investment. I think it's $50,000 per person per year. So you can't really, as an individual, make investments offshore. So it's very difficult to redeploy your capital in China. So a lot of them just buy, long bonds or whatever it is that, are on very low yield. So you just keep funding China, because ordinarily in any other economy, if you kept throwing money and stimulus at it, you'd cause inflation. But with China, they have productivity gains, A, and B, they export a lot of stuff and have sent both capital and goods. So you go and find new markets to operate in where you can find lower cost of labor and put your technology in. Is that, in their instance, throwing money at it hasn't caused an inflationary effect, whereas it has clearly in the US and elsewhere. But, you can't, the model is broken in the sense that the rest of the world can't have China keep compounding at 10% economic growth when it's all export driven. It's madness. They're going to run everyone out of business. And they've moved into more and more sectors that's part of the problem is now they're onto EVs and they've got on top of it. That's a real threat to the auto sector and a lot of jobs worldwide.
Do you know, America consumption as a percentage of GDP in America is like 70%. In China, it's like
Yes.
what, 40, 50%?
Yeah, less, I think even.
Less than that. So
I need to
again,
check.
why can't that? I mean, the government, they have a very low social safety net. You said, property and stocks, they don't have much investment in, but like the government could definitely
No,
put
they have
in
investment. They just
government's
haven't done
social
well.
policy.
The
Okay.
S&P's done a hell of a well, and China's index has been flat because companies don't make money.
Okay, but the U.S. with stimulus checks and other ways to stimulate consumer spending. I mean, China could do that, couldn't they?
I guess you could, but I mean, if you look at the average wages in China, everyone says China is a bigger economy than the US. When you look at purchasing power parity and at the individual level, they don't make a lot of money. So they don't have a lot of borrowing capacity. So a personal a debt elsewhere in the world is a lot higher. And if you look at somewhere like Australia, where housing is a big thing, personal debt's very high. Whereas in China, it's not really as much. But you look
Is
at
that a
wages in.
philosophical thing? Is that a philosophical thing, or is that like a government policy thing? Like
Well,
In America, we have like, we encourage debt, credit cards and mortgage deductibility. There are policies there that I mean, this is something that is it not possible in China, like because we're pressuring, I think that's part of the grand bargain is that China needs to stimulate domestic consumption.
It does, and the way to that, would be helpful is if you build up obviously a middle and an upper middle class, which is more likely to happen in more advanced and higher tech industries than it is factory workers and low end service things. Someone, quite a well known economist, posted like job openings in I think it was Shanghai or somewhere, and basically for a lowish entry job, you got some accommodation, but it was essentially $750 a month as a salary to work there.
Right.
So that's pretty
Not
tough.
much.
Yeah, it's not much. So when you fight on tight margins, you have wealthy elite, and then you sort of missing a segment, in between. And then I guess there's always the desire to externalize capital out of China at every opportunity.
Mhm.
As soon as you have capital controls, I come, originally from South Africa where we had capital controls, and then everyone wants to take their money out because They don't believe in the true exchange rate and where they're getting their best return. So gold, you've seen that go bananas in China recently because they
Hmm.
do have access to that.
Right. Okay. Um, it's interesting. Who could take from this? Who's going to blink? Cuban Missile Crisis analogy. Uh, you know, who has greater willpower, right?
Yeah,
It could last longer,
when
the
you read
Chinese or the
tea
Americans.
leaves, look, China, as far as I'm concerned, Besant's correct in that they are economically under pressure. They don't have a hand to play. However, you listen anecdotally to a lot of the economists that speak to the supply chain, and a lot of people are saying if this keeps up by June, July, they're going to have problems with inventory levels.
China
So you
is.
can't, no, the US,
No, U.S. is okay.
because you've allowed your supply chains to be completely globalized.
Right.
So, it's, I don't think, people expect it to go on for too long. So for how much longer can people run down? How much inventory would someone carry? And then are they going to pay the tariffs with the next lot coming in?
I just think fundamentally, the Chinese can take austerity more so than Americans. Um,
I guess it's back to my point, Howard, is I believe that China can stimulate with a lot of money into the system without causing an inflation jolt,
right.
is my view. So
Do you think?
that
Do you think
you know,
Besant is treating China like he did the British pound, right? With this like harsh negotiations.
I think that Donald Trump felt he had the stronger hand, which in a sense he does, but he doesn't have a stronger hand indefinitely, and supply chains are what they are. So, the US had a nice long period of good growth and modest inflation because they allowed, they had a strong dollar and globalized supply chains with people selling at, the rest of the world, emerging markets plus China, made it so that prices made sense in the US and was competitive. So they kept it, and some productivity gains, they kept prices very low. So tariff has a threat, as guys say, if you're a small business, you've got to pay the tariff before you've even got the goods through, out of the warehouses and onto the shelves and sold. So, um, if you run a 1.2 trillion deficit, and even then you've got to look at the component, how much is services versus how much is goods. Can the US have a protracted tariff battle? I think, what did the guys, what did they say on the podcast? My guess is no.
Yeah, I think the markets are forcing his hand, Trump's hand, and again, it's not just the equity markets; it's the bond market and it's the currency, right? And China's diplomatic, trade policy, they're not, just sitting still. They're talking with their ASEAN client states. They're talking to the EU. So for all this, it sounded like they wanted to corner China, but America wanted to corner China by signing deals with India, Japan, and other countries. And there's conversations going on, but no deals yet. So we shall see where that stands. But interesting dynamics at play. You are seeing, as I said, U.S. policy. This Doug Burgum, talking about equity investments, and political. I'm sorry, insurance guarantees, and stockpiling is all very interesting. As is the seafloor mining. Um, on the other hand, in private markets, you have CATL is looking to raise $5 billion next month. Ahead of that, they put out some very good earnings. Our friend Daniel Jimenez, commented about that. You could see a very sharp fall in their profits, in 2022, which corresponded to the spike in lithium prices. And now you see them having, very good profits ahead of this IPO. But they also had a tech day where They put out, next generation batteries and fast charging, as did BYD, and also some sodium ion battery announcements that some are worried about. So, could you talk about those as well as the most recent Citibank note overnight, which downgraded, their lithium outlook and recommended, initiating some new shorts in lithium?
Yeah, just to cover the Citi one, my oversupply for the year wasn't much less than theirs. They were at 73. I've been around 40 to 50. Short is quite aggressive because, Howard, even at 73,000 tons, if something goes wrong where there's a hiccup or a shutdown, you can get rid of that 73 pretty quickly.
Hmm.
So I think that's a bit aggressive. It's considering that shares have already fallen. I mean, looking at Pilbara and some of the others, so it seems a bit tough. So I'm a little less than them, but yeah, I mean, oversupply, it looks like it for the year, but we're quite close to the lows in terms of what people can produce or sell. I think guys will start reining in if it goes much lower. I don't think people will operate at full
In, in relation
capacity.
in relation to that, I noted at the beginning of the year, however bad lithium felt, if you look at valuations on the scoreboard compared to where they were at the bottom, in COVID times, they were still very highly valued. So relatively highly valued. So, and they could fall, quite a bit further. And they now have fallen a lot further. I see our friend Matt Fernley commented that now may be an interesting time to start looking at lithium equities because, they've fallen so much. But the Citi note was talking about lithium prices possibly falling further, to 7,000 or 6,000, and spodumene going to like 700, arguing to some degree that the lepidolite and other projects that China has, domestically, are lower cost than the market believes.
Well, I don't understand how you would get 700 spodumene because if you use 7.5 tons, you're already, you know, 5,500 for spodumene plus conversion to get to 7. So someone would be losing a lot of money there. You'd need to see maybe 6 or below. To be honest, Howard, if it were to go to 7, that actually would be something that would make me very bullish then, because that would finish a few people off, and not many could stay in business. Some you'd start to have shutdowns then, I think.
Okay, great. I was looking at, MinRes is 17. I bought MinRes, 5, 6 years ago at 17. And you and I interviewed Lucas Sam of Albemarle in 2019 when the stock was in the 50s, and that was around the bottom. And, that the 50 was the price that Albemarle paid for Rockwood. So this whole lithium as a specialty commodity and this great, industry, it's really turned into, well, we've known this, but it's just another stark reality how much it is a trade. And the question is, like, we had YJ Leon. There's still lots of optimism on the demand side. It's still very much, it's gone back to becoming like a China dominated story, or almost a China only story. We had Tesla's earnings results were a little bit of a damp squib on the, the lower cost models coming out. We'll see. Uh, but again, in China, you have CATL is about to raise 5 billion. BYD raised 5.6 billion. I think Xiaomi, I can't remember if they've raised it or they're planning to raise 5 billion. So these three major Chinese companies in the EV battery supply chain raising real capital. They've got, I'm sure they're doing it because they see big demand coming, and that demand hopefully translates into less oversupply, of lithium. So why don't you talk about what you've seen in CATL's Tech Day?
Yeah. So once again, an example of how far they've come. And looking at, I saw Iola Hughes, another regular on our show with how much BESS has had in demand in Q1 and planned. So that's running at a hell of a pace. Again, low-cost batteries are always hugely supportive of that industry. But yeah, I mean, CATL and BYD have made huge advancements. I think everyone thought that, Tesla had a huge moat in terms of what's on offer. And, from the battery side, they've really pressed, but they dominate the battery market with over 50% market share. So, again, Howard, that means that top-end batteries and high-spec batteries are going into those brands you mentioned in China.
Right.
So they are going to be very competitive when they export and send those out. I mean, these cars are impressive.
No doubt. When I was in Budapest, I was just hanging with a friend of mine who was more left wing. I'm more kind of like center right. But he was just like, with respect to the auto industry, he's like, look, I'd love to buy, a BYD, and who cares? Like if I could buy a $20,000 awesome car that was subsidized by the Chinese, right? That's a net positive to me, right? Like the Chinese government has supported my lower, we want to get lower inflation. So, um,
But
and,
unfortunately,
and,
that's
yeah,
why the tariff war exists, because that's been going on in everything.
yeah. Um, okay. But, so CATL came out with some, new technologies, right, for faster charging of cars. And did you digest that
Look, I
much?
mean, Howard, it's like what they're claiming on the specs of their sodium-ion batteries. You've got to real world test these things. They make a lot of claims and then they're not quite as good as what they say. But the fast charging is one of the hurdles and one of the major hurdles to EV adoption. So that's going to make it hugely popular.
Hmm. I want to switch a second to just Canada. They're about to have an election, I think on Monday. I listened to an interview with Carney by Scott Galloway. I'll put that in the show notes as well. I thought that was interesting. I had never really listened to him at length. And polls, if you look at Polymarket, it looks like 80%, likely that he's going to win. Although the liberals versus conservatives, it show only about a 4 or 5% lead. But assuming Carney does win, um, he was making some interesting comments about it's interesting. Since he had his conversation with Trump, Trump has not said anything about the 51st state. So, you notice that it has gone quiet. He hasn't been beating up Canada in the last few weeks.
He's got a few other things on his plate, but yes, I mean, that's the other thing is, doing Greenland, Canada, tariffs. The guy doesn't have a problem taking everyone on all at once.
It is hard, but anyway, for our viewers here, again, we'll put a link to the show notes. I thought it was interesting. He said though that a lot of the Canada-U.S. Tariff relationship is on autos, steel, and aluminum, and these are highly relevant to what we do. But he said, intra-Canada trade is going to be a focus. He's also still supportive of the energy transition and believes in, net zero and these things. But he was saying if we can't sell our aluminum and steel to America, we sell it internally in Canada, Canadian companies will get that cheaper, right? So there could be a competitive advantage to some degree in steel and aluminum, for projects within Canada. And just wondering if that might benefit, uh, critical minerals projects and lithium, and other
Yeah, I'm not
uh,
sure you can just pivot
commodities.
that quickly to domestic demand. We'll find out about that soon enough. I don't think it's that easy. But yeah, again, we'll have to see in terms of the autos as well. You know, there probably is some adjustment on that, but again, you've got to look at the scale of it and all of the items. But I'm sure they should find a way with Canada. You don't want to be, the North American free trade. You don't really want to dismantle that now. So I'm sure they'll find a smoother path there.
Right. Okay. We also had a conversation out of Chile earlier this week, and like Boric, it can't be reelected, I think, in November. So, and SQM has not yet signed their deal with Codelco, and we just heard some. We talked about SQM having ramped up production so much in the past few years as a major factor outside of Africa supply and lepidolite and China supply, and their inability to continue to ramp up as fast over the next kind of number of years. But this person we spoke to, basically said, like, SQM is not liked in the country, nor is Codelco, and the indigenous populations and the environmental considerations are very significant. So anyway, it's just something to watch from an election point of view. We have Canada coming up right now, but later this year, Chile is not featured so prominently, in the discourse, and I think that's something important to watch.
Yeah, I mean, I know how do you always like the SQM debate about their attitude towards sales. I think probably the interesting part there is to watch the offshore SQM to see how the Australian and other projects
Yeah,
evolve.
I- we'll see what happens. We heard there was some rumors that India might be taking a stake at a reasonable valuation. The other comment about Chile that was interesting, I thought, like, China muscled their way in with Tianqi, 6-7 years ago, and um, but China's very dependent on copper. I just thought they could muscle Chile around, versus the U.S. And this person we spoke to was, no, that's not really the case. China has free trade agreements with the U.S. and with the EU, and China's as reliant on Chile's copper as Chile is reliant on China as a market, for its copper. So it's not. This was vis-a-vis like how does Tianqi vis-a-vis SQM, play out? Because it looks like Tianqi keeps fighting it because they got massively diluted. He was arguing from like 20% to like 11% through the Codelco deal. So anyway, lots of, I don't know exactly how that plays out, but there's, again, we were talking about CATL. China got what they want. Even if Tianqi isn't doing well on that investment, China got a lot of benefit out of their investment in SQM, because SQM ramped up their volumes enormously and sold a lot of their volumes to CATL at low prices, and CATL's profits are high as a result of that, and their dominance in the industry has been facilitated by low-cost carbonate from SQM. A question, and this was in our bull-bear debate with Chris Robb in November. The U.S. is supporting a lot of critical minerals, but a lot of the critical minerals that they're supporting are currently in oversupply, right? So if you add supply to an already oversupplied market, what does that mean, for prices of like lithium and other commodities? If you look at Lithium Americas made a final investment decision the same week as Liberation Day week, right? What company in their right mind, makes a final investment decision with so much uncertainty, when lithium prices, are so low? I guess a company, there are price floors, built in from GM that made the U.S. government, Jigar Shah's loan, comfortable that if they produce at this cost, they'll make money because of those price floors. So, but if you have price floors and you have this new supply coming, and if Doug Burgum, makes equity investments in a whole bunch of other projects, what does that mean? Like, commodity equities follow commodity prices, right? There's going to be a lot more supply, maybe, lower prices. We have to onshore the supply chains. I mean, selected winners, right? If you find a company that the government is going to back, right, that'll be a winner, right? Like the metals company might be one such company in this respect. Lithium Americas, you know, the government made a bet on it, but it wasn't an equity bet. It was, it does have a big debt, but it was through, GM. So I guess, what do you think about that, right? If America's really, and the EU follows, we invest in these supply chains because
Yeah,
we
but
have to.
I mean, my counter to that is, I mean, if you pulled out of doing an investment every time prices are low, you could never get anything built. The trick here is they got a large amount of debt, like at a low rate, and the feasibility study says they'll operate at a low OPEX, which means they should operate through the entire cycle. So if you want a critical mineral and you want domestic supply of it, the best you can do is have a low OPEX operator. So once the CapEx it's in, and yes, it was high, but OPEX is what will determine how it survives through the cycle. And then you want a low OPEX operator. By the time it's built for all we know, lithium could be back at 50,000 a ton. So, who knows? And from an OPEX perspective, it is low. And from the price floor, GM, whoever, should still be very competitive with a price floor in the teens
Right.
as a cost. So hopefully the whole, supply chain and symbiotic relationship works through thick and thin. I mean, I think that's really the trick here. So, um, wanting, if you look at, we're not going into it now, but humanoid robots, etc., it requires. I think lithium is the second highest relative to annual supply needed for humanoid robots and so on. And this is the future for all of this. Is everything is electrification. So you do need domestic sources. So I think that's the call. And if that is the future, you're going to need a multiple of where we are now. So in the end, stuff has to get built. So I see the logic in, as long as things work technically. I see the logic in onshoring and having, good supply chains like Hyperion X for titanium and so on. More the better if you've got a low cost and proprietary technology. But I think it's important, especially if you're looking to reshore manufacturing and get competitive again, nothing better than having a low cost domestic supply of something.
Right. I agree with all of that. It creates a wrinkle in the investment evaluation and thematic, in that it's not just commodity equities follow commodity prices. As I tweeted in response to Steve Levine yesterday, keep your eye on who are the winners, right, that the U.S. or Europe may pick, right? Like, because the companies that are going to get funded, or equity investments, are stocks that people are going to speculate on, right? So that's why the metals company is up so much, right? It's at a 1.7 billion market cap now, up from 500 million market cap, in a matter of months, because an executive order was passed, and that's a high grade nickel and copper project that will be very low cost. It could create a new industry and be disruptive in a number of ways. But there are other projects like Piedmont Standard Lithium was up even NP Materials was up, Talon Metals and nickel was up yesterday, following these Burgum comments. So these, even though the prices of these commodities are not great. So with that, I think you've got to get on an airplane. Have a good week in Malta, Rodney, and
Okay.
look forward to catching up, and don't look at your phone too much, but because a lot can unfold, by the time you're back.
Alrighty.
All right.